I'm back, guys. PCB trading you on the intermediate level. On the intermediate level, we'll be covering fundamental analysis, technical analysis, and other important information which traders must know. A mix of fundamental analysis and technical analysis covers all angles. They say fundamentals move the market, which is true. In this video, we'll be focusing on the fundamental analysis. Let's get to work, guys. Yeah, guys, there are two main types of analysis that traders use to predict market movements and enter live position in forex markets, which is fundamental analysis and technical analysis. A forex trader will tend to use one or a combination of these to determine their trading style, which fits their personality. According to our strategy, we will be using a combination of these two analyses. Fundamental analysis. This analysis is interested on the why. Why is the forex market reacting the way it does? Forex and currencies are affected by many reasons, including countries' economic strength, political and social factors, and market sentiments. The biggest fundamental analysis indicators: news and economic data. Investors and banks look for strong economies to place their funds, in expectation that their capital will appreciate. This is because the currency of that country will be in demand, as the outlook for the economy encourages more investments. Any news and economic reports which back this up will then see traders want to buy that country's currency. Central bank and government policy. Central banks determine monetary policy, which means they control things like money supply and interest rates. The tools and policy types used will ultimately affect the supply and demand of their currencies. And government use fiscal policy through spending and taxes to grow or slow the economy, may also affect exchange rates. Government and central banks, their aim is to stabilize countries' currency, especially the developed countries. Economic indicators. We will be focusing on 6 economic indicators. The first one is non-farm payroll. What is the non-farm payroll report? Non-farm payrolls, NFPs, are the measure of the numbers of workers in the United States, excluding farm workers and workers in a handful of other job classification. This is measured by the Federal Bureau of Labor Statistics, BLS, which surveys private and government entities throughout the US about the payrolls. The BLS reports the non-farm payroll numbers to the public every month through the closely followed employment situation reports. Non-farm payroll is an employment report. It is released monthly on the first Friday. It heavily affects US dollar, bonds market, and stock markets. The second one is gross domestic product. What is gross domestic product? GDP. Gross domestic product is the total monetary or market value of all finished goods and services produced within countries' borders in a specific time period. As a broad measure of overall domestic production, it functions as a comprehensive scorecard of a given country's economic health. Tough. GDP is typically calculated on an annual basis. It is sometimes calculated on a quarterly basis as well. In the US, for example, the government releases an annual GDP estimated for each fiscal quarter and also for the calendar year. The individual data sets included these reports are given in real terms, so the data is adjusted for price changes and is therefore net of inflation. As GDP measures all the finished goods produced within the borders of a country, an increase in GDP is good for a country's currency and a decrease is bad for a country's currency. The third one, interest rates. What is the interest rate? The interest rate is the overall lending rate in a country, which ties into the overall rate worldwide. A country's interest rate is either the stipulated amount which commercial banks borrow from one another, or the rate at which commercial banks may borrow from the central bank. The most important interest rate is set by central bank, like the Bank of England (BOE), which affects all other interest rates in an economy. Central banks of very influential economies such as the United States, the UK, and China will affect developing countries' rates too. Because interest rates play a central role in spending, central banks use them to influence the entire economy as they have trickle-down effects. If the rate is hiked, the increased cost of borrowing by banks is passed on to businesses and consumers, who then pay increased interest rates on loans, which also constrain spending. If the interest rate is reduced, loans become cheaper to pay back and spending increases. The fourth one, the Federal Open Market Committee, FOMC. The Federal Open Market Committee, FOMC, consists of 12 members, the 7 members of the Board of Governors of the Federal Reserve System, the President of Federal Reserve Bank of New York, and 4 of the remaining 11 Reserve Bank presidents, who serve 1-year terms on a rotating basis. For traders, FOMC meetings are a time particular volatility because any change in federal fund rates can affect a range of economic variables such as short-term interest rates, foreign exchange rates, long-term interest rates, employment output, and price of goods and services. The FOMC meets 8 times a year to discuss monetary policy changes, review economic and financial conditions, and assess price stability and employment output. These meetings take place every 6 weeks. 4 of these meetings feature a summary of economic projections, which is SEP, followed with a press conference by the chair. The minutes of the scheduled meetings are released 3 weeks after the date of the policy decisions. Country's currency would increase in interest rates, you'd see its currency increase. A currency would lower interest rates, you'd see its value of its currency decrease in long term. It is the opposite for stock markets. An increase in interest rates, you'll see stock markets falling since banks are discouraged to borrow money for investors. FOMC, it is a meeting about interest rates decisions on whether to increase it or decrease it or to be constant. The fifth, Consumer Price Index, CPI. The Consumer Price Index is a monthly measure of change in prices paid by consumers for goods and services. It is an index that measures the change in price of a representative basket of goods and services such as food, energy, housing, clothing, transportation, medical care, entertainment, and education. Consumer Price Index, CPI. You will see traders comparing forecast and actual of CPI. An increase in CPI is good for the economy, a decrease is bad for the economy. The last one, market impact of unemployment rates. Lower than expected unemployment rates tend to appreciate currencies because traders believe that it could lead to higher interest rates. Alternatively, greater than expected unemployment rates could weaken currencies as it is expected to lead to lower interest rates. Traders use CNBC and economic calendar. I use Forex Factory to be updated on what is happening on our economy as a whole. There's still another video which I'm gonna make about technical analysis and other information which traders they use. So guys, always be updated on us. Thank you.